Good morning. Today we are going to discuss about a new topic which is one of the very interesting, current and very favorite topic, that is money, banking and central banking. In this chapter we are going to learn 5 important aspects of the chapter. We have 5 learning objectives. First, we'll define the functions of money, identify the key properties that money possesses, and explain the official definitions of money supply. Second, understand why the financial intermediaries such as banks exist. Third, describe the basic structure and function of the Federal Reserve System. Fourth, determine the maximum potential extent that money supply will change following a Federal Reserve monetary policy action. Fifth, explain the essential features of the Federal Deposit Insurance. Our second learning objective is to understand why financial intermediaries such as bank they exist. Let us explain the official definition of quantity of money in circulation. Money is important. Changes in the total money supply, that is the amount of money in circulation, and changes in the rate at which money supplies increases or decreases affect important economic variables. And what are they? Inflation, interest rates, employment, and the level of real GDP. Economists have struggled to reach agreement about how to define and measure money. Have a look at the international policy example. What does the Zimbabwe now use as money and why? Between 2000 and 2008, Zimbabwe's central bank printed so many Zimbabwe's dollars that its annual inflation rate ultimately reached 500 billion%. The value of the Zimbabwean dollars became so unpredictable that they were no longer readily acceptable in exchange for goods and services. This led the central bank to begin replacing the Zimbabwean dollars with currencies of other nations. Have a look at the image, the picture of the dollar, and see the value over there. Do you find that interesting? Now you can buy some of the dollar notes around like $10 even from the eBay or Amazon. So Zimbabwe's $100 trillion bank note of 2008 with a AA series, a lot of can be purchased with a less worth of money. There are basically two approaches to define and measure money. One is your transaction approach, which give emphasis on the role of money as the medium of exchange, and the next one is liquidity approach, which focuses on the role of money as a temporary store of value. Here, we'll focus on the transaction approach to measure money, and that we call as M1. And what is M1? The money supply measured as the total value of currency plus transactions deposit plus travelers checks not issued by the banks. Okay, three things: currency and coins, transaction deposits, and traveler checks. So let us first focus on currency and coins. The largest component of US currency is the paper bills called as the Federal Reserve notes, which are designed and printed by the US Bureau of Engraving and Printing US currency. It consists of the coins which is minted by the US Treasury. Federal Reserve banks issue paper notes and coins throughout the US banking system. The second one is transaction deposits. Individuals transfer ownership of deposits in financial institution by using the debit cards and checks. Hence, debitable and checkable transaction deposits are normally accepted as the medium of exchange. The depository institutions that offer transaction deposits are numerous, and it includes commercial banks and almost all the thrift institutions like the saving banks, savings and loan associations, and the credit unions. Last but not the least is the traveler's check. Traveler checks are paid for by the purchaser at the time of transfer. The total quantity of the traveler checks outstanding issued by the institutions other than the banks is the part of M1 money supply. American Express and other institutions, they issue travelers checks. Have a look at the image figure with panel A and figure panel B. Panel A shows the estimates of the M1 money supply, of which the largest component, you can see here, the largest component is transaction deposit with 56.4%. M2 consists of M1 plus the other three components, the most important of which is savings deposit at all the depository institutions. And you can see here its percentage is about like 67.5%. Now, I'll talk about the second approach, the liquidity approach to measure the money, M2. What is M2? M1 plus the saving deposits at all the depository institutions. 2. Small denomination time deposits. 3. Balances in the retail money market mutual funds. The liquidity approach to define and measure the money views money as the temporary store of value, and so it includes all of the M1 plus the several other highly liquid assets. When we talk about highly liquid, it means it can be easily converted to cash. For example, time deposits. So, the component of the money includes the saving deposits, that is the total saving deposits, deposits with no set maturity, and they are the largest component of M2 money supply. The second one is the small denomination deposits, time deposits. With time deposit, the fund must be left in a financial institution for a given period before they can be withdrawn without the penalty. To be included in the M2 definition of money supply, time deposits must be less than $100,000. Hence, the designation small denomination time deposits. The third one is money market mutual fund balances. Many individuals keep part of their assets in the form of like shares. So they invest in the money market mutual funds. These are highly liquid funds that the investment companies often obtain from the public. All the money market mutual fund balances except those are held by the large institutions and are included in the M2 because they are highly liquid. Now, the important aspect of this chapter is to focus on the financial intermediation and banks. Most nations, including the United States, have a banking system that encompasses two types of institutions. One type consists of privately owned, profit-seeking institutions such as commercial banks and thrift institutions. The other type of institution is a central bank, which typically serves as a banker's bank and as a bank for the national treasury or finance ministry. So, if I ask you what is a central bank, what you would say? It is a banker's bank, usually an official institution that serves as a bank for nation's government treasury. Central banks normally regulate the commercial banks. These banks or financial institutions, they provide different types of financing. What are they? One is direct finance, another is indirect finance. When individuals choose to hold some of their savings in new bonds which are issued by the corporation, the purchases of the bonds are in effect the direct loans to the business. So this is an example of direct finance in which people lend funds directly to the business. Business financing is not always direct. Individuals, they might choose instead to hold time deposit at a bank. The bank may then lend to the same company. In this way, same people can provide indirect finance to a business. The bank makes this possible by intermediating the financing of the company. So what is financial intermediation? It is the process by which the financial institutions, they accept savings from business, households and government and lend the savings to other business, households and government. So, any kind of financial institution, they will collect funds from us because we are going to deposit that in the bank, and they will also give as loan to individuals like us or maybe to different companies and government, and that is called as financial intermediation. And what are financial intermediaries? These are the institutions that transfer funds between the ultimate lenders or the savers and ultimate buyers. You can see here the figure which shows the process of financial intermediation. The ultimate lender and the ultimate borrowers are the same economic units, like individuals like us, or we can say households, all the businesses and government. But it may not be, same individuals. Whereas individual households can be the net lenders or borrowers, households as an economic unit typically are the net lenders. Specific businesses or government similarly can be the net lenders or borrowers. As economic units, both are the net borrowers. Now, Let us consider a question. Why might people wish to direct their funds through a bank instead of lending directly to a business? Think of it. To answer this question, we have to understand few of the concepts that are mentioned over here. One is asymmetric information, then adverse selection, moral hazard, large scale and lower management cost. So the first reason is, which is also a very important reason, that is asymmetric information. The businesses may have better knowledge of its own and future prospects than the potential lenders do. For example, the businesses may know its intents to use the borrowed funds for the projects with high risk of failure that would be, repaying the loan difficult, or that would make the repayment of the loan very challenging, very difficult. The potential for borrowers to use the borrowed funds in the high-risk projects is known as adverse selection. Alternatively, a business that had intended to undertake low-risk projects may change the management after receiving a loan, and the new management may use the borrowed funds in riskier projects. The possibility that a borrower might engage in the behavior that increases the risk after borrowing funds is called as the moral hazard. To minimize the possibility that a business might fail to repay a loan, people think about lending the funds directly to the business must study the business carefully before making the loan, and they must continue to monitor the performance afterward. Alternatively, they can choose to avoid the trouble by holding the deposits with financial intermediaries, which then specialize in evaluating the creditworthiness of the business borrowers and keeping the tabs on their progress until the loans are repaid. Thus, the adverse selection and moral hazard both help to explain why people use the financial intermediaries. Another reason is that the financial intermediaries, they exist, that they make it possible for many people to pool their funds, thereby increasing the size or the scale of the amount of savings which are managed by an intermediary. This centralization of management reduces the cost and risks below the level the savers would incur if all were to manage their savings alone. For example, pension fund companies, which are institutions that specialize in managing funds that individuals save for retirement, owe their existence largely to the abilities to provide such cost savings to individual savers. Likewise, the investment companies, which are the institutions that manage portfolio of financial instrument called as the mutual funds on the behalf of shareholder, also exist largely because of the cost savings from the greater scale of operations. In addition, government sponsored institutions such as the Federal National Mortgage Association seek to reduce the overall lending cost by pooling the large volume of funds from the investors in order to buy the group of mortgage loans. My next point is financial institutions' assets and liabilities. Every financial intermediary has its own source of funds, which are the liabilities of that institution. Because if they borrow money, if they collect money from others like individuals, business or government, they have to pay back, right? because that are not their own funds. So that becomes the liabilities of the institution. For example, the amount owed or any kind of legal claims against a business or households by the non-owners. These are the sources of funds for the financial intermediaries. When you place $100 in your transaction deposit at a bank, the bank creates a liability. It owes you $100 in exchange for the funds deposited. A commercial bank gets its funds from the transactions and saving accounts. An insurance company, they get their funds from the insurance policy premium that we pay. Just like liabilities, each and every financial institution or intermediary have some assets, and they have different prime use of its assets. For example, the credit union, any kind of credit union usually makes small consumer loans, while, or we can say, whereas a saving bank makes the mortgage loans. So assets are those amounts which are owned, all the items to which the business or households have a legal claim on it, and these are the uses of funds by the financial intermediaries. And you have to be very careful that the distinction between the different types of financial institutions are becoming more and more blurred. Their role, their functions are blurred. As the laws and regulations change, there will be less need to make any kind of distinction. Because if you can see, earlier the primary function of the bank was to accept the deposits, to have saving deposits for the customers, and to give loans and advances. But the role and function of banks is not just limited to the deposit accounts and the loans. There are more than that today. Now refers to this table, which shows the financial intermediaries and their assets and liabilities. For commercial banks, saving and the loan associations, saving banks and credit unions, the assets are car loans, consumer debt, business loans, government securities, home mortgages, and the liabilities are transaction deposits, saving deposits, various other time deposits. For insurance companies, the assets are mortgages, stocks, bonds, real estate, and the liabilities are insurance contracts, annuities, pension plans. In case of pension and retirement funds, the assets are bonds, stocks, mortgages, time deposits, and the liabilities are the pension plans. In case of money market mutual funds, short-term credit instruments such as large denomination certificate of deposit, treasury bills, high-grade commercial paper, and the liabilities are the fund shares with limited checking privileges. In case of government-sponsored financial institutions, the assets are the home mortgages and the liabilities are mortgages which are backed by securities and issued to the investors. Here is an example relating to the customer who pays fees to hold hundreds of billions in the deposits at bank. Recently, some of the US banks like the JP Morgan Chase and the Bank of New York began charging the interest rate at 3.5 to 5.5% on the deposits of at least 300 billions. And one of the reason for this charge was that the new government regulation made it more costly for the bank to hold those funds. And another reason was that lower interest rates on the loans and bonds, which make the deposits unprofitable without imposition of the storage fees. Here is an example relating to how a debit card transaction is cleared. Suppose there is a student and his name is Jill Jones. He uses the debit card and that is issued by the Bank of America. He uses that to purchase clothing and that worth the $200 from Macy, that department store. And Macy has an account with the Citibank. The debit card transaction creates an electronic record that is transmitted to the Citibank. The debit card system forwards this record to Bank of America, which deducts $200 from Jill Jones' transaction deposit account. And then the debit card system transmits $200 and makes the payment to the Citibank, which credits $200 to Macy's account. Here is another international example. Why bother with a debit card when payments can accompany tweets? Banks in France, India, United Kingdom have allowed people to attach transferal of payment to Twitter messages. The amount of such Twitter directed transferals of payment from the bank deposit account already exceeds like $7 billion and has been growing at an annual pace exceeding 25%. Thank you for your kind attention. If you have any questions relating to this topic, feel free to ask your questions on the Google Doc that I have shared with you. You can post your questions on the discussion board as well. I'm also available via Zoom to answer any of your queries, any of your questions relating to this chapter. Thank you.